Hello traders community. Today I will discuss the smart money concept. How to trade the markets based on market makers' footprints, big banks, hedge funds, and financial institutions. Unfortunately, most traders rely on price action patterns, supports, resistances, and technical analysis in general, and more than 90% of them are still unprofitable. If you think that you are going to beat the algorithm of trading with indicators, you are so wrong. There is no indicators, robot forex, or mechanical trading system that will make you money if you don't understand the logic behind market price movement. Indeed, when you rely your decisions on indicators, you are not really trading the market. You are really just plugging numbers into a few mathematical formulas. Notice that the most popular indicators have been created in an era where modern computer systems of trading didn't even exist. Stochastic was created in 1950s, MACD in 1960s, and RSI in 1970s. The signals formulated by most indicators represent an issue of time lagging. For example, the delay between the cross of the EMAs and the direction of the markets is remarkable. Thanks to smart money concept, you'll trade using a naked chart without being confused by any indicator noises. How is that even possible? Let's take a look around liquidity concept. Taking liquidity within your trading plan is a big probability gainer. How often did you get that your bias was on point, but you got stopped out by a wick? Also known as liquidity grab or stop hunt. This happens systematically over and over again. Market makers are beating the most common retail trader methods such as trend lines and price patterns. Double top, double bottom, wedges, and triangles. If 90% of the traders are using these methods, then the algorithm of trading programmed by big banks will be able to recognize some levels of price that have a bunch of stop losses. In fact, smart money relies on retail traders to provide liquidity and will push price to an area where retail traders place their stop losses. So when trading smart money concept, we look at the market from a different perspective. We are not trading like the big institutions, but we simply follow them. We should know that for every buyer we need a seller. Therefore, liquidity serves as fuel for the market maker. Liquidity areas occur essentially where people are placing the stop losses or where pending orders are being set. So for example, at a double bottom or a double top, we have liquidity sitting there. Why? Because we have breakout traders looking to take the sell or the buy at the level of supports and resistances. So what institutions are doing? They are triggering these breakout traders as well as taking out these sellers and then pushing price. This is a form of grabbing liquidity. However, liquidity is also sitting at every single high and low. Why for a bullish trend we have liquidity sitting at every single low? Because there are breakout traders expecting bullish breakout to happen and putting stop losses just below the old low. So sometimes what happens is, say for example, institutions are creating this move. If they don't have enough liquidity to continue their move, they will push price down, grab that liquidity, and go upper. Same thing for a bearish trend. There is liquidity sitting above every single high. You can grab that liquidity and then push down, simple as that. We can even break more structures, but that is just a liquidity grab. Smart money understands human psychology. They know that most traders are controlled by two main fears: FOMO and the fear of losses. Frequently, they will use good or bad news to enhance their trading positions and to capitalize on known human weaknesses. The media spread misinformation that misleads most of investors. Market makers recognize the human herding effect. They have a holistic view of traders' investment preferences and will make sure to use their euphoria to manipulate the bias of the market. Thanks to smart money concept, we can take high probability sniper entries with less risk. We'll see the market from big banks' perspective, identifying the bias and waiting for the stop hunt and liquidity to be grabbed before taking our trade. The use of wider order blocks and mini order concept could reduce your risk to its finest point, and taking a target that represents more than 5 times your risk ratio. Your understanding of the logic behind every small market move will allow you to scale your trading style to the next level. Your interpretation will no longer be the same, since you were looking at the chart from a market maker perspective and not from a retail logic that relies on signals provided by indicators. In this course, I'm going to teach you step by step how to trade futures like market makers and how to spot liquidity levels as a target. By following these steps, you'll be able to take high probability trades with a small risk and a very rewarding target. Besides the institutional trading, we'll be dealing in depth with the interbank price delivery algorithm. The market makers use this algorithm to detect the high liquidity levels by using price and time. By mastering price and time theory, we'll get more precision to find our sniper entries. The analysis of market structure and the good risk management are a key to enhance your winning rates. So we'll focus also in this course on how to study the monthly, weekly, daily bias and how to manage your risk. Last but not least, we'll discuss the psychological aspect of trading, dealing with fear of missing out and fear of losses.